Facebook plummeted after their results were announced in the first quarter. On April 27th, they announced these results. 7% revenue growth, but a 21% drop in net income and an 18% drop in diluted earnings per share. Why only 18%? They bought back some shares in the quarter. Facebook has plummeted and people are wondering, is it dead? Because the user growth wasn't big. Well, again, guys, if the user growth isn't big, but you pay a cheap enough price, it can still make for a good investment, right? Because it's not what you pay, it's what you get. That is what value is. Okay, so let's go look at the analyst expectations for Facebook for the coming years. Revenue estimates for the next 10 years. So this company that has very little user growth, look at the revenue growth potential according to analysts. 126, 147, 170, 190, 210, 220, and so on to 260. So over doubling in the next 10 years, about 7%, 8% revenue growth per year. Okay, let's look at their earnings per share estimates for the next 5 or 6 years. 1181, which is a 14% drop from last year, but all the way to $20. Why? Because, guys, even though user growth might not be big, as the world develops, there'll be more and more profitable ads that Facebook can sell to advertisers. There's still the metaverse they haven't even scratched the surface on. There's still Oculus. All these things they're still working on, I believe, could add a lot of profit and revenue per user that even though their user growth is stagnant, the revenue per user can still increase substantially, and that is the entire play on Facebook. But before we determine what price to pay for Facebook, let's go through our 8-pillar process to look at Facebook as a company. So we go to our Everything Money software, 8 pillars tab, type in Facebook, Meta Platforms. So guys, look at the stock plummet. High of 384, and it hit a low of 169 recently, but it's currently at 201. Okay? First things first. Market cap for Facebook, if you want to buy all the shares out, $567 billion. Pillar number 1, we want the 5-year PE to be under 22.5. On our main page here, 21.93, check mark there. Pillar number 2, we want the 5-year return on invested capital being greater than 9%. It is 16.3% right here on the main page. Guys, this company does a really good job of investing the money that's in the business. That is what invested capital is through debt and equity. They've done a great job with that. No dividend, but look at their free cash flow, guys. In the last 5 years, their average was $24 billion. In the last 12 months, it's $40 billion. So they're almost double their last 5-year average in the last year, and the stock is down a ton. Now, that can still happen in overvalued situations. But just keep that in mind when you're thinking about this company. Because remember, when you buy a stock, you are buying a piece of a business. And that's something you need to remember over long periods of time. You're buying a piece of a business. Pillar number 3, we want to see revenue growth over the last 5 years. So we go to the income statement in our software. We go back 5 years, 43.88 to 120 billion. Check mark there. Pillar number 4, we want net income growth the last 5 years. So we scroll down on our income statement on our software. 17.86, 37.34, over doubling. Check mark there. Pillar number 5, shares outstanding. Guys, a lot of tech companies, a lot of overvalued companies issue shares like crazy that dilute the investors in the business. They're taking the investors that currently exist and saying to them, guys, I'm sorry, we're going to split up the profit even more amongst other people that you did not ask for. It's dilution. It hurts people. People never look at it. It's the silent killer for investing. So you scroll to the very bottom of the income statement. The end of 6 years, we had 2.89 billion shares outstanding, and now 2.73. Check mark there. So they've been a net buyer of stock over the last 5 years. Okay. Now, as the stock gets cheaper and cheaper, you hope the company buys more and more shares back. We don't like it when companies buy overvalued shares, but the stock is getting cheaper. So pillar number 6, guys, debt is an important aspect of any business. We want to make sure that companies can support the debt. So what do? We go back to our main page of our software. We have all the main data we need. We look at the 5-year average free cash flow, 24.3 billion. We multiply that by 5. That's $126 billion. We want their long-term liabilities on their books to be less than $126 billion. So we go right to the balance sheet on our software, scroll to the top, go to the balance sheet, scroll all the way to the bottom, Total long-term liabilities, $19.9 billion. Guys, their total liabilities are $41 billion. They can pay off almost all their liabilities with 1 year free cash flow. Their long-term liabilities with half a year of free cash flow. Imagine that. Imagine you at home and you can pay off all your mortgage, your car payments, your student loans, those major long-term liabilities with 6 months of your free cash, of your earnings. Imagine that. That's what Facebook can do. So it's harder for companies in this kind of financial situation to go into bankruptcy. Because how do they go into bankruptcy? Who do they owe? If a creditors ever annoy them, you know what they do? Here's your check. Please be gone. That's it. Pillar number 7 and 8 have to do with free cash flow. So we go up to our cash flow statement in our software. We scroll down. Free cash flow is cash from operations less your capital expenditures. You can do one of 5 things with that money. You can buy back shares, pay dividends, pay down debt, reinvest in yourself, or make acquisitions. Those are the one. You can do 1, 5, none of these. It doesn't matter, but you can do those 5 things with free cash flow. So here's your cash from operations less your capital expenditures. We added this line because this statement does not actually have this, but we do the math for you. 5 years ago it was 18.75. Last year, 39.8. That is a check mark there. Over double. And our final metric, we take the 5-year average free cash flow, 24.3. We multiply it by 22.5. I'm going to try to do this in my head. That's 480, 525, and another 7. Call it $530 billion. Let's see how close I was. This is where I try to get cocky about my my math skills. 530 divided by 22.5, 23.5. Oh, I was slightly off. It's like $540 billion. Guys, that was pretty impressive though. $547 billion. So we want their market cap to be under $547 billion. So let's go back to the main page. And their market cap was 567. So that's an X. But again, let's go to the 8 pillars tab to look at this. That's actually an X, but remember that valuation and PE and price of free cash flow should be a moving number. It should be based on growth potential. It should be based on profit growth potential. Because think about it. If you have 2 companies, each one makes $1 million a year in profit, but one has 100% growth potential and one has 5%, which one will you pay more for? Absolutely the one that's going to have 100% growth potential. So PE is not just, growth is the most important, one of the most important aspects of value investing. What is their growth potential? And based on analyst expectations, they think the revenue growth potential is still pretty solid for this company, 6 or 7% a year for the next 10 years. That's not great, but it's not zero. It doesn't match the user growth. So we're going to use this information in our stock analyzer tool right now to figure out how much to pay for this company based on assumptions. Now, the important part is you get the software and do the assumptions yourself, but this is just a starting point for everybody to look at. It doesn't mean go buy, but it's a starting point to say, should I spend more time on this? So let's go to our software. We go to the stock analyzer tool. We're doing 10 years of analysis. Now, revenue growth. Analysts think 6 or 7%. So my goal is to be conservative. I'm going to go 4, 7, and 10% revenue growth. And the reason I say 10, we haven't touched Meta. What if Meta is the next thing? And all of a sudden, they're the leaders of it. You better believe their revenue growth can be huge. Profit margin. I'm going to go 28, 30, and 32. Same with free cash flow. Because guys, we have to invest in the future into Meta and all that stuff. PE, 13, 15, 17, 13, 15, 17. And finally, guys, desired annual return, 12.5%. You can get 9 or 10% by investing in an ETF. So to give yourself margin of safety and a reason for buying an individual stock, do 12.5%. Hit the analyze button. The stock is currently at 201. So low level, 154, high level, 313, middle, 219. So add this to your watch list by clicking the plus button. Adds it to the watch list, notifies me when it goes over whatever price I want to go over or under, and follow the stock. Thank you very much.